Hi, everyone. Larry Bailey here, bringing you another market news update. Today is September 23rd, 2024. We're going to be going through the stories of what happened in the market last week, September 16th. Let's get into these stories because the Fed started cutting its interest rate, the benchmark Fed funds rate. It cut it by 50 basis points, or 0.5%. And that was due to a lot of factors that we're going to be going through. Even though in August, construction ramped up due to a large part of lower mortgage rates, here's the main stories. Here's that top one. The Fed cut its interest rates by 50 basis points. Let's talk about what that means. The next one is existing home sales slip. The next story is home building confidence rose after 4 months of sliding. The next story is August saw a surge in single family home building. And then we get into surprise gains in retail sales. Last but not least, continuing jobless claims reflect hiring slowdown. We'll get into all these stories and more. Thank you very much for watching these videos. If you like what you're seeing, go ahead and please subscribe, hit the like button for the video. Let's get into what's going on here. So the first story, Fed cut its interest rates by 50 basis points. So the Fed's new easing cycle began last week as they cut their benchmark federal funds rate by 50 basis points. This brings it to a new range of 4.75 to 5%. This decision was not unanimous, though, and it's important to point out because the Fed Governor Michelle Bowman wanted less aggressive or a 25 basis point rate cut. The Fed funds rate, remember, is the interest rate for overnight borrowing between banks and the Federal Reserve. It's not the same as mortgage rates. As a matter of fact, mortgage rates actually baked in a 50 basis point because, if you don't know mortgage folks, they're gamblers. So they were banking on 50 basis point cut anyway. The Fed delivers it. And what's really funny is interest rates, when the Fed lowered the interest rates, mortgage interest rates actually ticked a little worse. Money got a little bit more expensive, mostly because of the comments from the Fed, not the actual cut, but the comments. And so this is on the backdrop of the Federal Reserve, remember, started hiking its federal funds rate back in March of 2022 to try to slow the economy down and curb away that runaway inflation that we all were feeling the pain of, mostly because of the pandemic. So more recently, the cooling consumer inflation and the rising unemployment caused the Fed to acknowledge that, quote, the time has come for the policy to adjust. Bottom line in this story is, of course, that the Fed is trying to raise interest rates, trying to ease interest rates to keep the economy from entering into a recession. And they're currently forecasting another 0.5% cut by the end of this year, with an additional 1% cut by the end of 2025. So these forecasts, of course, may change in either direction as the economic data presents itself to the Federal Reserve. In addition, it's important to always remember that mortgage rates may not directly follow the Fed's funds rate. And this is what I just said to you. It's a very interesting pattern between mortgage interest rates and the 10-year Treasury and the Federal Reserve, the Fed funds rate. They do not align like step for step. Historically, they've been in alignment, but they do not align every step of the way. It's really important. So remember, if, like I've always said, if you find good money, take it. If the mortgage deal that you're trying to get for the property you're trying to buy or refinance makes sense, do it. Do not wait. I know of some folks that did not lock in because they thought that the Federal Reserve dropping interest rate, the Fed funds rate, is going to drop mortgage rates. Whoever they were working with, gave them some bad advice or didn't really press on the borrowers enough. Those borrowers actually ended up getting the money cost more after the Federal Reserve lowered the overnight rate for borrowing versus beforehand. Again, this is welcome to mortgage banking. Past movements are not a predictor of future movements. Always remember that. All right, let's get into the next story here. Existing homes sales slip. So this is all about the trend of existing home sales, and this is important because one of the other stories we'll talk about is new home construction. So the existing home sales were weaker than estimated per the National Association of Realtors, that's the NAR, as August's transactions were down 2.5% from July and 4.2% from a year ago. This report measures closing on existing homes in August and likely reflects people that were shopping for homes and went under contract in June and July, before the mortgage interest rates dropped. So, bottom line here is it's a little bit murky. While the number of closings declined in August, some of the internals within the report point to a demand that's out there. Homes remained on the market for an average of just 26 days in August, while almost a quarter of the homes, 24% to be exact, sold above list price. Lower mortgage rates also expected to spur activity in coming months. We'll see. And there were some folks that talked about the affordability factor and how interest rates can play into that. And absolutely, is there a difference between a 7.5% mortgage and a 5.5% mortgage? Duh. Yes. So we'll see what happens here with affordability, but you still got to find the house and you still have to negotiate a price, right? So regarding that, the inventory, there were still 1.35 million homes available for sale at the end of August, which is up 0.7% from July and 22.7% from a year earlier. It's 22%. While this sounds like a big jump, because it does, this rise is from very low numbers in inventory. Yes, and that's the thing. Like it's like saying, "Hey, we've got 10 houses for sale and we've got 20 houses for sale," and that's a 100% jump. Yeah, but it's still only 20 houses, right? So this 1.35 million homes sounds like a lot, but it's actually not. This is very, very tight supply. Remember, we've got 300 something million people in this country. If you have that and you say there's 150 million homes, to say that we've only got roughly 1% available for housing, it's not a good supply. We'd love to see it bigger. So, with all this lack of supply, of course, there's always demand. There's always households being formed, which results in higher prices, which results in, as I said a moment ago, if you find a house and you can afford the mortgage, take it, get it, whatever it is. If mortgage markets end up getting better down the road, great, you can figure it out by then. As always, folks who have bought a home 5 years ago or even 2 years ago are seeing appreciation, at least on paper. And so it always lends yourself to consider that as a way to build up equity and to build up the appreciation of housing over time. You want to make sure that you enter into housing as soon as you can, as long as it's something that you're comfortable with. So let's get into new home construction. This one is home builder confidence. This is rising after 4 months of sliding. And again, everything's relative, right? So the falling mortgage rates have led to an improvement in home builder sentiment. The National Association of Home Builders, that's the NAHB, that reported that their housing market index increased 2 points, 41, 2 points. In September, however, sentiment remains in contraction territory. Anything below 50 is considered contraction. So if you look at the chart here that I'm looking at, it was 51 back in April, and it's been sliding ever since. The low point was August at 39, and now it's back to 41. Okay. So the bottom line here is while builders are still pessimistic, as indicated, we did see an improvement in all three index components, which is buyer traffic, current and future sales expectations. Of note, the index measuring future expectations jumped 4 points, which is good, and that jumped it back into expansion territory above 50. The NAHB's chair, Carl Harris, explained, quote, "Thanks to lower interest rates, builders now have a positive view for future new home sales for the first time since May of 2024, close quote." All right. Thank you, Mr. Harris. Next story that we have is August sees surge in single-family home building. So we're still going to stick on the new construction because, again, if you don't have retail sales, you got to get housing from somewhere, right? So after a disappointing July, housing starts rose 9.6% from July to August, hitting their fastest pace since April. The starts for single-family homes, which are especially crucial to buyer demand, were also higher by a large jump of 15.8% to the upswing. There was a similar trend in future construction, with building permits moving higher from July to August. I'll say this, again, depending on where you are in the country and depending on what kind of house is being built, a new permit July being issued means just that, it's a permit. So it's going to take time to get those houses delivered. And that ties into here. So while new construction home rebounded in August, led by the huge boost in single-family construction, building permits, which is a sign of future construction, hit a 5-month high, which is good. This increase in permits shows that builders feel more confident. That's why they're pulling permits. about future construction. And as remarked earlier, it's really due to these lower interest rates, which it's not about the rate, it's about the affordability, right? So if I don't want to lower my prices and I still want people to afford, that means that I've got to have lower interest rates, right? And so this sentiment isn't because the home builders feel better about more people exclusively. That's a good thing. But it's also about if I have people able to afford more of a house, I get to keep prices at where they are, or maybe even rise a little bit. So, when there's risk, there should be a reward. And that's, again, part of what I see as why builders are feeling better, because not only do more people can afford a higher price. That's my own personal opinion. Next story is continuing jobless claims reflect hiring slowdown. So initial jobless claims fell by 12,000 in the latest week, with 219,000 people filing for unemployment for the first time. Continuing claims also declined by 14,000, as 1.829 million people still receiving benefits for the first time after filing their initial claim, I should say. Bottom line in this story here is continuing claims have now topped 1.8 million for the last 15 weeks straight. That remains near the highs that were set in November 2021. While continuing claims have fallen over the last few weeks, this likely encompasses benefits expiring, as well as people finding new jobs, given that the hiring rate is 3.5%, and that's near the lowest level since 2013, of course, not including COVID. So we're going to go on to what to look for this week. We're going to look for more housing news. We're going to have, starting with appreciation data from July from the Case-Shiller and the Federal Housing Finance Agency. That's going to happen on Tuesday. August new home and pending sales will be reported Wednesday and Thursday, respectively. Also on Thursday, we'll see the final reading on the second quarter of GDP and the latest jobless claims. Friday brings the most crucial report of the week, which is the Fed favored measured. I'll give you a second to think about it. Yep, you got it. It's the Personal Consumption Expenditure, also known as PCE. My name is Larry Bailey. Thanks for watching these videos. I hope they've been helpful. And stay tuned for next week's market news. We'll see what happened this week. And then we'll see you there. Take care.